Tesla released their production and delivery numbers before the market opened on Tuesday, and investors seem really excited about it. They beat analyst estimates by a decent margin, not a huge margin, and the stock continues to climb in early trading on Tuesday. But let's take a step back and actually think about what's happening at Tesla. Tesla's deliveries were actually down 5% year over year. Production was down 14% year over year. So is this fundamentally going to change the company's trajectory? Remember, margins have been declining for about a year and a half now. That is likely to continue in the second quarter. And Tesla continues to lose market share, particularly in the US. So I want to put all this data into a little bit more context, because a lot of the headlines I'm seeing today are that Tesla beat estimates. Well, estimates are just a guess at what the quarter is going to look like. What's more important, what's actually happening with the trends with the business. And the trends are almost all negative for Tesla's EV business. At the same time, the stock continues to rise. This is a company that trades for 10 to 20 times competitors' price, depending on what you're looking at, on the thesis that there's going to be some sort of growth in the future. And we're not seeing that actual growth. So let's dig into the numbers. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's go right to the numbers. This is the second quarter 2024 numbers out from Tesla this morning. 422,405 deliveries of the Model 3 and Model Y. That continues to be a vast majority of the company's sales. Other models, which includes Cybertruck, Model S, and Model X, pretty modest at 21,551. I think they're only doing about 1,000 Cybertrucks per month at this point. And one thing that you'll notice in this is pretty significantly higher than the amount of production. Now, Tesla has actually been building inventory over the last 12 to 18 months. So that production number was a little bit higher than deliveries. That squeezes your cash down. And so what Tesla is apparently doing here is actually reducing their production at a pretty significant level. If we go over to second quarter 2023 numbers, they were producing almost 480,000 vehicles. There are going to be a few impacts from that. So not having inventory, vehicle inventory, is going to help your cash balance. But the reduction in production is going to mean that your fixed costs, so everything from engineering to the cost to run a building or build a plant, is going to be spread across fewer vehicles produced and delivered. So that means that your gross margin and your operating margin, if everything else is equal, is going to go down when production goes down. That's just the way that it works in manufacturing. This is one of the reasons that it's such a difficult business to be in, because if production and deliveries start to drop, that is going to have a huge impact on your income statement. So that is exactly what we're seeing. Deliveries were 466,140 a year ago. That is down to basically 440,000. So deliveries down, production down even more. What is that actually going to tell us about what is going on with the business? Well, this is a look at the company's delivery trends and the margin trends. And you can see that the deliveries are going to be up quarter over quarter, but down year over year. And things are kind of bouncing around flat over basically the last 6 quarters now. So Tesla is not in growth mode. Remember, the only vehicle that they've really introduced over the last 5 years is the Cybertruck. Like I said, doesn't appear that that's going to be any sort of meaningful number of sales. But look at that margin trend. Look at operating margins. Peaked at 19.2%, was just 5.5% last quarter. It's likely that is going to be maybe not lower than last quarter, because deliveries were pretty low last quarter, but it's probably going to be in the 6 to 8% range. And that is going to be about the same as other automakers. The other thing that I would think is worth noting is what's going on with the industry overall. Now, we don't have full second quarter numbers yet, but Cox Automotive is really on top of things from a month-to-month basis. So they got a pretty good idea of what's going on in the first half of the year. They say that auto sales are expected to finish the first half higher by 2.9%. So Tesla sales are going down. Remember, that's a global number. That's not just a US number. That's a global number. But US sales are going up. I think it's probably pretty likely that China's auto sales are going up, especially for EVs. So Tesla appears to be losing market share. The other thing to think about from a margin perspective and a volume perspective is how much is Tesla subsidizing the sales that they're making, particularly in China. And I think China is going to be a really good one to watch, because the Chinese market is extremely competitive. That's going to be kind of a canary in the coal mine for the rest of the world. but they have extended a zero interest loan offer into the third quarter. So that was apparently really successful in the second quarter, but they've also extended that into the third quarter, and that's extremely expensive. What Tesla ends up doing, what any automaker ends up doing if they're offering financing that's better than what the market would actually offer, is they end up buying down those interest rates. So they're either going to hold those loans on their books at a lower interest rate than they could actually get with the cash that's on the balance sheet. So for example, if you're getting 5% from treasuries, but you're offering a 0% rate for your customers to take out a loan, everything else equal, you're giving away that potential interest that you could be collecting on that money. The other thing that you would do if you're working with third parties is just simply pay them money to offer a 0% rate. And then the bank or the lending party would actually work out how to offer that rate so that they can make money. So you don't lower the sticker price of the vehicle per se, but you do increase the cost because you're actually paying to offer that financing. And that's what's going to hit margins. And this is one of the reasons that I think Tesla's margins are going to continue to decline as the EV business gets more and more competitive. This is why the stock price reaction is so strange to me, because I don't think any of this is bullish for Tesla's bottom line and free cash flow. And ultimately, that is what should drive Tesla stock and every stock long term. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. I talked earlier about Tesla's falling margins. That ultimately makes its way to the income statement and to free cash flow. If we look at this chart of operating cash flow in red and free cash flow in blue, you can see that Tesla's operating cash flow went to almost negative in the first quarter, and free cash flow was a negative $2.5 billion. Now, free cash flow is going to include all kinds of things like capital expenditures that maybe don't currently reflect the value of the business, but long term, what you're going to want to see is growth in free cash flow. So Tesla is a mature automaker. You're going to want to see increasing free cash flow. And what we're seeing with the decline in margins, with the decline in their actual production, is that free cash flow and operating cash flow is not going to increase. And this is what makes this so puzzling to me, because at the end of the day, you have a slowing growth company, a company where revenue is negative, where free cash flow is negative, and yet shares trade for 58 times earnings. The price to free cash flow, even on a forward basis, is 117. It's very possible that they're actually negative free cash flow over the next year. Meanwhile, competing automakers, which are apparently gaining market share based on that Cox automotive data that I talked about earlier, are trading for price to earnings multiples between 4 and 6. They're generating more free cash flow than Tesla. Their margins are stable. So I think when you look at the actual trends for Tesla's business and not just what it was compared to from analyst estimates perspective and what sort of the vibes are in the market, Tesla's business is actually in decline. Sales is going down. Margins are going down. Free cash flow is going down. That's not what you want to see from a business. So fundamentally, Tesla is not in a great place. Now, I also question the future of things like robotaxi and a humanoid robot, but that's a story for another day. The auto business as it stands today is not as strong as it was 3 years ago, and yet the stock has not dropped to where you would expect it to if it was going to trade similar to competitors. Still potentially 80, 90% downside if it were to do that. So what do you think about Tesla stock today after the quarterly numbers came out? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.